My name is Jeffrey Kennedy, and welcome to Trader's Classroom. If you're a currency trader, you have my respect. And the reason why is because I consider currency trading to be extremely difficult, especially on the intraday price chart level. So if you're looking at, say, a 5 or 15-minute price chart of currencies and you're trying to trade the euro for 10 or 20 pips, that type of endeavor to do it consistently over a long period of time, from my own experience, it's extremely difficult. So if you're successful at it, you have my admiration. Now, one thing I actually do myself to overcome the confusion that I often see sometimes in the price charts of currencies on an intraday basis is to simply step up the time frame. So what we're going to be looking at today in today's episode is I'm going to show you how by increasing the time frame of your currency price charts, it often yields greater clarity. So let's begin. Now the price chart in front of you is that of the dollar index, and this is a monthly price chart that I believe I showed much earlier in the year, I think maybe in April and May. And this is just a classic head and shoulders formation. So many of the tools and techniques that we use on a daily basis in Trader's Classroom are equally applicable to the currency markets and again on these larger time frames. This is just a basic head and shoulders formation. Left shoulder, head, right shoulder, here's our neckline, and we still have that 105 neckline measurement target. Again, to identify the neckline measurement, you simply identify the length or the distance between the neckline to the head and project it upward from the breakout point. So we've actually had this price chart working for us in Trader's Classroom since, again, I think back from April or May of this year. Now, if we take a look at a price chart of the euro, for example, well, even if you have just a basic rudimentary knowledge of the Elliott wave principle, the price action that we've seen transpire this year in the euro, is this a 5-wave move? Is this an impulse move? Now, the reason an impulse wave is so important is because an impulse wave points the direction of the larger trend. Well, there's nothing impulsive about this price action, so we can look at the euro this year and see that this is clearly counter-trend price action because, as my good friend Jim Martin says, if it's not a 5, it's a 3, and if it's a 3, it's a counter-trend structure that we can expect it to be more than fully retraced once complete. So whenever this formation does expire, I do expect the larger downtrend in the euro to clearly continue. There's some other things that we can look at. And again, these are basic techniques and basic, say, momentum signatures that we talk about and discuss every day or certainly every week in Trader's Classroom. Here's what appears to be a zero-line reversal utilizing MACD. This is the British pound, by the way, on the weekly chart level. We have two higher highs right here in price, but notice they're unconfirmed in our MACD histogram. So this is a classic bearish divergence. Also, notice how prices are coming up and encountering moving average resistance. Again, these are just classic basic momentum signatures, but rather than trying to find them on an intraday basis, where sometimes you'll have multiple signatures, some work, some don't, by increasing the time frame, these signatures will be fewer and often more reliable. If we take a look at, say, for example, the dollar Swiss utilizing the weekly price chart, notice the moving average compression. Now, this is Daryl Guppy's heat map or Daryl Guppy's tool where he's looking at multiple moving averages. And the reason why is we're trying to identify compression points. For example, back here was a compression point in the moving averages on the weekly chart level. Whenever you see the moving averages compress, that basically means you actually have a period of price compression as well. What's exciting about this condition is that it's a condition that cannot last for any length of time. It's certainly not going to be a permanent state of the market. So whenever you're through compressing, you'll see expansion in the moving averages or increased volatility in price. So with the moving average compression we clearly see in the dollar Swiss, well, as we move forward into the remaining few months of 2015 and most likely into 2016, we'll probably see these moving averages begin to expand and increased volatility in this market. Here's an Elliott wave pattern utilizing the Canadian dollar. We've talked about this price chart before. This is just a classic impulse wave up from the May low. 1, ABC down for 2, 3. Notice that wave 3 pushed just a little bit above the 1.618 multiple of wave 1 at 131.69. We do have a double close key reversal as of today's trading, so maybe that's a wave 3 top. So now we can look for a classic three-wave decline, probably a flat, so we can apply the guideline of alternation. Look back to near the previous fourth wave extreme of 1 lesser degree, which comes into play at 128.61, which is very near the 382 retracement of the wave 3 advance coming into play at 127.99. Again, very basic stuff. And also, too, if we look at the prior swing price highs, this is what I would consider to be structural, at that point, structural resistance. Now that prices are trading comfortably above these two price highs we saw earlier this year, I will be looking for it to actually provide support for any type of corrective decline that we may see in the next few trading days. And also candlestick patterns. I find candlestick patterns more clear and also more reliable on the larger term time frames. This is a price chart of the New Zealand dollar, and we've clearly been in an obvious downtrend for many, many weeks in this market. But notice again the number of bearish engulfing patterns. Here's a doji, a number of bearish engulfing patterns. We have a number of also failed bullish engulfing patterns along the way. But each one of these, I think, offer basically a high probability or a high confident selling opportunity within the current downtrend in the New Zealand dollar. We can also utilize our percent R tools. And the way I've explained our percent R tools is this portion here. Whenever the histogram bars of the 20 period are below 50, the trend is clearly to the downside. So we view these moves right here as counter trend moves. Again, selling opportunities here and here and here and here. If you find intraday currency trading frustrating, and I know I do, maybe you don't, and that's great. And if you don't, and you're successful at it, you're doing something I can't. But if you're looking for something a little bit easier, because again, trading is hard enough as it is, certainly the consistently successful type of trading, then I recommend moving up at your time frame. So rather than focusing on that 5, 10, 15-minute price chart, maybe go to the larger term time frames, the 60-minute, the 240-minute, or preferably, say, the daily. I hope this helps. Thank you very much, and I'll see you tomorrow.